Hello, I'm Tom Cadigan, Associate Director of Alumni Relations and a proud member of the Holy Cross Class of 2002. And wherever you may be zooming in from, I want to welcome you to today's Alumni and Parent webinar event, brought to you by the Holy Cross Club of Greater Boston. Today's topic hits home for many of us: planning for retirement. Our presentation today is titled Creating Your Retirement Paycheck: Strategies to Help You Live the Life You've Earned. I'll certainly be taking notes. Now, some housekeeping items before I introduce today's presenter. We'll be together for just about an hour. We'll have some prepared remarks, and then we'll take questions from you for as long as time allows. And I encourage you to submit questions throughout the presentation using the Q&A function located on your toolbar. Keep them coming. I'll return later in the webinar to facilitate your questions. And now it's my pleasure to introduce our terrific presenter, Daniel D'Agata, class of 2004, an experienced Boston professional and a long-standing volunteer with the Holy Cross Club of Greater Boston. He currently serves as the club's treasurer. Daniel is a certified financial planner with Ameriprise Financial and has led many seminars and webinars like this for Holy Cross alumni, parents, and friends. And we are so grateful for his involvement today. Dan, welcome. We got the memo. We're wearing the same shirt.
Thanks, Tom.
Yeah.
Hello, everyone. To echo Tom's comments, thank you for coming here today and joining us on the presentation. So I'm a certified financial planner with Ameriprise Financial. I've been doing this since graduation, so since 2004. And I specialize in retirement planning, education planning, investment planning, and estate planning clients. So whenever I do these types of events, I always try to start off by, in a way, apologizing, because these are broad-based corporate seminars, meaning that not necessarily that they're meant for the masses, but it is meant for a general audience. So there's obviously only so many details that we can get into today. Each slide, we could have our own hour-long presentation and seminar. So at the end of this, you may say, geez, that wasn't helpful, or I already knew everything, or my question didn't get answered, or you may even say, geez, Dan's really dumb. And that might happen. But what I ask of you is that I don't want you to come away with nothing. So hopefully there's something on one of these slides that's helpful for you. Whether you're just starting out to plan for retirement, or whether you're approaching or even in retirement, hopefully there's something here that could benefit you. And if there isn't, like Tom said, ask away. If it's something I can answer, fine. If it's something I don't know the answer to, I'll be sure to find someone who's smarter and better looking, and they'll be able to get the answer for us. So today we're going to be talking about using various resources to create a stream of income to support the life that you've earned. So maybe you plan to spend more time with loved ones, or you plan to take that vacation you've always dreamed of. Perhaps you even master a different hobby or even a different career. Whatever the vision for retirement is, hopefully some of the information in this presentation can help you. So you may have spent as many as 40 years, maybe even more, building your investment portfolio. But now that your retirement is approaching, you just may be asking yourself, obviously, what do I do with that money? How much can I take out, and where do I start? Most importantly, can I make sure I don't run out? In reality, it's kind of like the mentality around it's kind of like losing weight, in that, your whole life, especially if you're a bigger guy like me, your whole life, your mentality is around, all right, how do I lose weight? How do I lose weight? How do I lose weight? And if you're ever fortunate enough to get to your goal weight, it's, all right, how do I maintain? Here it's somewhat similar in that your whole life, not just your working years, but even as a kid, it's, how do I save money? I got to save, I got to save, I got to save. Now you got to shift that to saying, all right, now I need to spend some of this, but you got to spend it wisely. So a good place to start is trying to level that out. Many people think that retiring just simply means switching from putting money in to taking money out, like I just said. But it is important to figure out how to turn that money into an income source, something that's steady that you can rely on over the years. And this is what we call the retirement paycheck. So we got to think about it a certain way. Before retirement, the majority of your income probably came from one of two sources. Obviously your job, and perhaps if you had a hobby or even investment returns. Now or in the near future, when you retire, instead of one or two sources of income, you could have many. So these could include your retirement accounts, your Social Security benefits, pensions, as well as any additional cash flow that you may get from rental properties, businesses, or lucrative hobbies. You'll find that I tell stories and that I go off on tangents, but one of these is about lucrative hobbies. I guess one, because of the pandemic, and two, because of the Last Dance documentary that came out last year about the Chicago Bulls. If any of you are sitting on either your own baseball cards, basketball cards, or your kids' baseball cards or basketball cards, it may be worth taking a look, because some of them, even some of the silly stuff that you never thought would be worth anything, is actually, it can be worth something over the past year. One of my clients does that, and he actually took a look at the stuff that I have, and it's not much, but it's better than sitting in the basement. But anyways, having a plan can help you coordinate these various income sources so they can be turned into retirement income. So there are many choices to be made, ranging from what kind of retirement account withdrawal rate that you want to set, to when to start receiving Social Security benefits. And you need to make sure you get your timing just right for each and every one. Most importantly, there's no one size fits all solution. You have to figure out what's best for you because everyone's different. To kind of give you an example, so as I mentioned, I do education planning along with the other stuff. So when I talk about education with clients, it's easy math in the sense that it's a large number. Tuition's expensive, and when you calculate all 4 years, especially if you have someone who was born recently in the last 5 years, and what that looks like 18 years from now, it's a ridiculously large number. But the math is easy. You have when the child is born, between years 1 and 18 to save the money, and between 18 and 22 to use it. 95% of the time, that's where the calculations fall. With retirement, do you retire at 60, 65, 70? Do you like your job? Do you not like your job? Do you want to stay in Massachusetts? Do you want to go down to Florida? Do you work part-time? Do you not work at all? There's so many different factors that go into it that it's sometimes the calculations can only do so much. But those are the different things you have to think about. And it's natural to feel overwhelmed by the process. But that's where I come in, because we'll run through a checklist of some to-do items. And again, ask the questions, especially if there's something that, that we can come back to based off the end of the presentation. So we're going to talk about the 3 most common questions. How much do I need? How much do I have? And how do I make it last? And let's go over a little bit each one now. And the biggest question on your mind is probably, how much do you need? The thing is, so what we're going to do is we're going to discuss this, but obviously I can't answer it because it requires a much closer look at your individual situation beyond what we can accomplish here today. The problem with my job, I'm not sure if there's any doctors in the audience as well, but I'm sure over the years you get asked questions at parties, and I get asked questions all the time. And unfortunately, a lot of the times the answer is it depends. And the looks you get are entertaining. I remember specifically it was Labor Day of 2015. And one of my relatives asked me a question and kind of said, "Hey, it depends. I can't give you a straight answer." And he just the look he gave me, I'll never forget. He looked at me like I was a jerk. Like, why can't you just tell me? So with this stuff, there's a lot that is going to be catered to your individual situation. There's a lot of it depends, but nonetheless, it can help, because if it's a practice you haven't done on your own, you'll want to meet with an advisor who can help you identify how much money you will need in retirement to create a plan to develop these income sources. And obviously, while I can't answer your individual need, I can go over some guiding principles to get you thinking. So people typically need 65% to 90% of their pre-retirement income to maintain their standard of living in retirement. Now, keep in mind, this is just a rule of thumb that deals in averages. Some of you will require less, others more. And according to the 2018 Ameriprise Financial Ages, Stages, and Money Study, financial and emotional preparation are keys to retirement success. Of the 1,000 people interviewed, all of which were between 60 and 73 and had retired within the last 5 years, 43% estimate retirement savings needs accurately. 28% need less money than originally expected, and 24% need more money today than they had expected. These stats are good starting points for coming up with a rough estimate for your retirement income, but there's a whole lot more that needs to be factored into your equation. So it's important to factor in things like time, including your life expectancy. So yes, you really do need to think about how long you could potentially live, where you have your money. In other words, which investments or investment strategies are right for you. Taxes, which are unavoidable even in retirement and even in death. Remember, the IRS likes you, but they don't love you, not the way mom and dad love you. Any unexpected incidents and accidents, and any deadlines for when you can take advantage of benefits like Social Security. We'll go over each of these factors in the presentation, but first let's talk about time. How long you live directly relates to how long you'll be retired, and it's going to impact the decisions that you make. So with today's longer lifespans, you'll likely be retired a good long time, but you're going to have to be honest with yourself. I had a reassigned client, meaning that the home office assigned him to me in 2005, 2006. And so when we started off with planning, we went the traditional, here's what it looks like that you'll need from to age 90 or 95. And he said, Dan, no one in my family lives past 70. We always, everybody gets cancer. And I was just starting out my career, and I thought, how do I do this? And my manager said, listen, if that's what the client wants, just that's how you plan for it. And sure enough, within a couple of years of that conversation, he had gotten cancer and passed away. And his sister became a client. She was the one that benefited or inherited the accounts. And she lasted a little bit longer, but she passed away of cancer about 1.5 years ago. And so sometimes you have to look back to your family health history and say, all right, do I have longevity in there? And if I do, you got to plan for that. And even if you don't have longevity in there, obviously you don't want to be wrong and just plan for 5 years of retirement when it could be 25, 30. Because time can also creep up on you. If you don't factor it in, time can erode your savings, making it that much harder to live the life you want in retirement. And here's one way to put it in perspective. So if you remember the cost of your first home, you wouldn't expect the house to cost the same amount today. You would obviously be paying much, much more. This is because of inflation, a key component of time. Inflation means the general level of prices go up, which we all know. So it becomes one of the more important parts for planning for retirement, because according to the Bureau of Labor Statistics Consumer Price Inflation Calculator, $100,000 in 2020 dollars has the same buying power as $41,000 in 1985, $59,000 in 1995, and $75,000 in 2005. Almost everything, from big ticket items like your house or to the small stuff like the pack of gum, goes up in cost over time. And the result is your savings can have significantly less buying power over time as well. That's why it's so important to estimate your retirement expenses, yes, in today's money, but you got to make sure you do that calculation based on future inflation. And inflation calculators can help give you a realistic idea of how much you'll need to save. They do that by taking your desired amount in today's dollars and then re-estimating it into dollars of the year you want to retire. And whenever you do that, that number is huge, just by default. I mean, I should say it depends on where you are in the retirement spectrum, whether you're close to retirement or if you're further away from retirement. But regardless, that number might give you a little bit of a sticker shock, and don't be alarmed. You don't necessarily need to keep working and saving until you hit that amount. Just a portion of your money should be in an investment portfolio that has potential to grow after retirement. So now the second question. How much have you actually saved for retirement? To answer that, we have to look at the different income sources that you'll be pulling from in retirement. Social Security and pensions. These are income sources that have few, if any, options for change once you start, which means that you will likely be locked into your decisions once you make them. Social Security is the most well-known example. If you haven't already, you'll soon have to choose when to begin receiving your Social Security benefits. Later, we'll talk about the pros and cons of waiting versus starting as soon as you're eligible. Pensions are an example of an irrevocable decision. Pensions have become less common in favor of 401k plans. But if you're lucky enough to have one, it's important to know it inside and out, because whatever choice you make will be a permanent one. This may mean the choice of taking a lump sum versus yearly income. You will also have to decide if you want your pension withdrawals to last through your lifetime or your lifetime plus your spouse's. And to help you figure out where you stand, consider requesting a breakdown of your pension options each year in the 5 years leading up to retirement. And if you need someone to take a look with you, that's what someone like me is for. That's what an advisor is for. But usually pension plans are broken into either the lump sum option or option A, which is just your lifetime, option B or option C, which is a lifetime plus your spouse. And there's varying degrees of that payment. And like the presentation says, whatever choice you make, that's it. It's a one and done choice. You have to make sure you do that math and you take all those factors into consideration. Together, Social Security and pensions might be sufficient to meet your needs in retirement, but for many, they probably won't be. Obviously, for some people they are, but increasingly, it's becoming more obvious that it's not covering everybody's needs. So if after these sources, there's a gap between your income and your expenses, no matter how much it is, you need to make sure that you're filling that portion of your assets from either 401ks or other accounts that can turn it into income. So employment income and home equity can be other sources of income that people don't often consider in retirement. These are income sources you may be able to turn on or off, options where you have much more flexibility. Employment income, the word retirement can be a bit of a misnomer because many people actually keep working once they retire. It's not I'm going to do nothing and sit on a beach for 30 years. It's not the 9-to-5 grind of employment that people find out, but instead it's maybe a small job that brings in a steady stream of income and plays off your interests and hobbies. For some, this can mean working a regular job, but at a reduced hours, or it could be taking on consulting work. For others, it may even mean volunteer work. But there are a couple things here to add. If you think about when we look at our plans and we look at the retirement age, at the retirement age that we put, that shuts down everything. So it shuts down income, it shuts down healthcare, it shuts down saving. From that point forward, it is assuming that you're using your assets and potentially other sources like Social Security and pension to live off of. If you're going to be working, doing anything, whether it's part-time work or another full-time job, anything you earn means that less is going to be required of your accounts. If it's $1,000 a month or $2,000 a month, whatever it might be, that obviously helps the situation. So it's important to look at that, and that even though you may quote unquote retire from your current job, you may not necessarily stop working. And even if it's doing something less, that doesn't pay as much, it's still going to help your situation. But from a mentality standpoint, you have to keep busy. Everybody we know who's older and still with it, it's because they kept busy. Not just they're out having a job, making money, but doing volunteer work, doing something worthwhile. That's what keeps your mind active. So it's important to make sure that if you're going to be doing that, chances are you're going to be living longer. And you got to make sure that's included in the conversation. There are some things to keep in mind though here. So if you decide to work during retirement, after you've started taking Social Security benefits, there's going to be tax implications depending on how much money that you're earning from your job. So be sure to talk with a tax advisor about how taking a job while receiving Social Security might affect your benefits. Also keep in mind that until you reach full retirement age, which can be between 65 and 67, depending on your date of birth, Social Security will subtract money from your benefit check if you exceed a certain amount of earned income for the year. Your benefits are reduced by $1 for every $2 you earn over that limit. In the calendar year you will reach full retirement age, for every $3 you earn over a higher annual limit prior to that full retirement age, you will see a $1 reduction in Social Security benefits. The month you reach full retirement age, you become eligible to earn any amount from employment without benefit reduction. So basically, what you have to keep track of is that if you're going to be working, earning money before your full retirement age, you have to make sure you're under certain thresholds depending on your situation. Once you hit full retirement age, you won't see a benefit reduction in your Social Security. It may be taxable, but it may not be reduced. Home equity is another income source that you control. If you have your mortgage paid off, you might consider trading down to a smaller home, which could lower your expenses and provide you with cash to help cover any income gap. You also have the option of taking a reverse mortgage, or even a home equity line or home equity loan or a home equity line of credit. Remember that your home is one of the biggest investments and can be readily available for a source of income. One piece of advice I tend to give clients who are approaching retirement is that as you're approaching retirement and you still have your income, you're still working, if there's any type of debt that you think you might be obtaining, whether it's a HELOC, a home equity line of credit, or a car or anything, while you have the income to prove it, it's better to get at that, especially on the home equity line. I'm a big proponent of having those to just keep in your back pocket. And while you still have a job, while you still have income to prove, it's better to get that and just keep it. Because if you try to apply for it when you're retired and you don't have the same level of income, it may be a little bit more difficult to get that. But when it comes to certain things, especially a reverse mortgage, you got to make sure you talk to your legal advisor about the pros and cons of all those. Because there are certain situations it may be the best thing for, in certain situations it may be the worst thing. Keep in mind that any businesses that you own can be turned into an income stream. You could sell your business, you can invest the proceeds of that sale, or you can keep the business and you continue to draw a salary from it. And if you own any rental properties, you could use the rent you charge as additional income stream. Finally, one of the biggest flexible income sources is your investments. So let's talk about those. Investments may include things such as your 401k, IRAs, non-retirement accounts, or even annuities that you have. So if you have a 401k, 403b, or an IRA, it's important to be aware of the different distribution requirements. If you have non-retirement accounts, such as brokerage accounts and bank accounts, you can tap into these for additional retirement income. In fact, some people go to these first in order to take withdrawals of tax-free principal or capital gains, maybe subject to a lower tax rate. In any event, it's one more option to give you greater flexibility. Finally, there are annuities. People hear the word annuity, and they may not be sure what that means. Annuities are a contract you buy from an insurance company, and in exchange for a sum of money, you lock in an immediate or future income stream, which you can receive monthly, quarterly, or yearly. You can buy an annuity at any age, but you have to keep in mind that withdrawals from an annuity or from a deferred annuity before 59.5 may result in a 10% IRS penalty, even if it's a non-qualified. So there were some changes last year, both the Secure Act and the CARES Act. So the age for RMDs, required minimum distributions, increased from 70.5 to 72. So individuals who did not turn 70.5 prior to 2020 don't have to take an RMD until they turn 72. For people who were 70.5 prior to 2020, nothing changes. More specifically, if you were born on June 30th, 1949 or earlier, nothing changes for you. If you were born on July 1st, 1949 or later, you get to wait until you turn 72 to take your RMDs. The slide says that in 2020, the RMD was waived. In 2021, that is back. So what does that mean for you? If you're in the group that gets to delay to age 72, what should the approach be? Do you say thanks and not take anything out of the IRA? I would argue that you have to take a more strategic approach to try to see if that makes sense. Because in many cases, just because you can leave your money in longer, doesn't mean you necessarily should. Many people have deferred large amounts of money on a pre-tax basis over the years. Those are assets that you'll have to pay tax on no matter what, when they come out of your retirement plan, and that can leave you with a huge tax bill. So delaying the RMDs can exacerbate this issue if it's not planned for properly. It may make sense to take a look at ways to shift some of that money to a tax-free position for later in your retirement, or to pass on to your heirs more effectively. Some individuals may consider moving funds to Roth IRA or life insurance. You will pay taxes now, but will move funds to a tax-free position for later distribution. And here are some additional considerations when talking with your advisor, even when you think about it yourself, about moving funds to a Roth IRA. So Roth IRAs allow you to pass money onto your heirs tax-free. Arguably a record low tax rate, which is what we're in right now, that is scheduled to increase in 2026, unless Congress acts. But it is expected by a lot of people that the tax rate is going to go up, because obviously we have a lot of debt, and the debt's only going up, and then we have a lot of unfunded liabilities. The other thing too is down markets are an optimal time for Roth conversions, like last year. So at the end of March of last year, one of the things we were reaching out to clients to talk about is it may be a good time to make a Roth IRA conversion. What that means is you're taking money from a pre-tax traditional IRA and converting that to a Roth IRA. So to make the numbers easy, if you have $100,000 inside of a pre-tax IRA and you convert that to a Roth IRA, the government now thinks you made $100,000. That is tax at ordinary income this year, or in the current year that you do. But now you have a $100,000 Roth IRA, and any future growth that is in that account, and anytime you make withdrawals, as long as it's after 59.5, are tax-free. So part of the reason why the down market is because when you look at last March, the market was down considerably. So that $100,000 account could be worth 60, 65. And so what you're converting is now only 60 to 65,000, and that's what you're going to be taxed on. And luckily or fortunately, as we've seen, that's come back. So sometimes in down markets, your windows are small. If there's anything we've learned from the end of last year, the markets can change on a dime in either direction. But that's one of the times to look at perhaps doing a Roth conversion, because it may make sense, because you're going to be paying taxes on the money anyways. But you got to consider your tax bracket today, with you and your beneficiaries' tax brackets later, and your ability to pay that tax with assets outside of the IRA. So if you make that conversion, you can't use some of the conversion money to pay the taxes. You have to have that somewhere else. And you also got to keep in mind that required minimum distributions are not eligible for conversion. So if you have to take money out of an IRA, you can't convert that amount to the Roth. It has to actually leave the account and not be converted. There's also some other recent updates for these, in that due to longer life expectancy, the tables that the IRS uses to compute the RMD have been updated, which result in a lower RMD for someone turning 72 in 2022, as opposed to previous tables that were used. Also, there is some talk about the RMD being pushed up to 75, but like everything else in Congress, sometimes it's just talk. Until you see it happen, that's what we're looking at. But that would be a big impact for a lot of people. So how can I help my retirement savings last? Well, first, you got to consider your withdrawal rate and timing. Be thoughtful about what you spend and when. There is a slew of age-based milestones and deadlines you need to keep in mind as you approach retirement. Make sure you're paying attention. Second, make sure you work with your advisor to help your investments work harder in retirement. So just because you're withdrawing funds from your investment accounts doesn't mean they need to stop growing. And third, you got to be strategic about the two things that could diminish your retirement income: taxes and unexpected events. We're all used to paying taxes, but the terrain changes a lot once you retire. And every time whether it's a new administration or a new Congress, the tax environment changes all the time as well. So when you're working, your taxes may be generally based on your employment income. Your salary is set, but you may also have other income. However, when you're retired, your taxes may be generally based on the income you choose to receive from your accounts. So depending on the type of accounts that you're pulling from may dictate your tax bracket. And you may have a greater control over what you pay in taxes and even when you pay. So while you may have more control, there will be other things you cannot control, and that's unexpected events. So the good news is that there are ways to protect yourself from those, from that certainty of uncertainty. And we'll talk about that in a bit. But first, let's talk about the withdrawal rate. Many people choose 4% for their retirement withdrawal rate, and that tends to be, somewhat of the standard mass, I guess, general audience or mass audience type number. And it's not necessarily wrong, because depending on a certain rate of return, if you're withdrawing 4% or less, the money lasts forever. And if you're drawing 4% or 4.1% or more, there's an end date somewhere. But the problem is, you got to be specific. You got to look at your own situation. You got to look at what it is that you need. You got to look at what's coming in from Social Security and pensions. That withdrawal rate may be more, or it could be less, depending on your needs and your lifestyle expenses. So when it comes to controlling what you spend in retirement, be careful not to go overboard early. The prospect of finally getting to live your goals and dreams, it's very exciting. But you got to remember, hopefully there's a potential to have 30 or more years in retirement. And the more you take out of your portfolio right away, the harder it's going to be to make that back, because unfortunately time isn't on your side at that point. You'll need to revisit this withdrawal rate regularly, making sure it stays in sync with your personal situation. So one of the stories I have is a client I had been working with for years. We had assumed about $6,000 a month for retirement. She retired May of 2018. So her first full year of retirement was 2019. Last January, when I met with her, she said, Dan, I know we planned for 6,000 all along, but it actually seems like it's 7,000. And, we were kind of talking about things, and, she kind of followed up with me and like, is there a concern? I'm like, there's no concern. Jill, you have enough money, but you have to think about what I think about is that we've planned for 6,000 a month for so long. And now year one, you say it's 7. If it stays 7, that's fine. But in my mind, I have to think about next January, is it going to be 8,000? Is it going to be 9,000? So you always have to, just like now, just like you do in your working years, you have to be mindful about what you're spending and be mindful about that withdrawal rate. Because if it tips the other way, it doesn't matter what the investments do. You're just looking for stuff to sell. And you never, ever want to get into that position, because that doesn't end well. So you always want to be mindful of the spending in the withdrawal rate. So at this point, we're going to go through some key age-based milestones and deadlines. So if you want to take some notes, this is probably it. So getting your timing right for these key deadlines is crucial. Ignoring, forgetting, or procrastinating on any of these really can mean the difference in thousands of dollars. So that's why you either might want to memorize them or make sure you build in enough time beforehand, so none of these feel rushed. So age 50. If you are 50, you can make catch-up contributions to retirement accounts, like your 401ks, 403bs, and IRAs. Obviously, this is a great way to boost your savings right before you retire. Whether that's the additional $6,500 inside of your 401k or the additional $1,000 inside of your IRA. At 55, if you withdraw too early from certain retirement accounts, at any age, you're going to get hit with a 10% IRS penalty. And that age is 59 and a half. That qualifies you to be able to withdraw without penalty. So if you're 55 and you left your employer that same year, this age 55 exception can waive you from the 10% IRS penalty. It only applies to employer-based plans such as 401ks and profit sharing plans, so not IRAs. So that's important to keep in mind. And if you are in fact retiring early, you may be able to take money from this without the penalty. You're still going to have to pay taxes on it. The taxes don't go away, but the penalty may, depending if you fit into that. At 59 and a half, like I just mentioned, that's when you can begin taking tax penalty-free withdrawals from your retirement accounts, IRAs, 401ks, whatnot. At age 62, you can start taking Social Security at a discounted rate. Should you? What do you think my answer is going to be? It depends. And don't look at me funny, because there's a lot of different things that come into play, whether you want to take it at 62 or the other couple of dates are going to be coming up in this slide, or your full retirement age of 65 to 67, or even waiting until age 70. It's a big decision, and it's important to weigh that decision in coordination with all the factors that we've been talking about. So it says 65 on the slide, but 64 and 9 months, 3 months before you turn 65, you can begin the process of applying for Medicare. You have a 7-month window to complete the application, but I encourage you to start early. So as soon as you reach 64 and 9 months, so you have plenty of time to make your choices, but that's when you want to start thinking about Medicare and start applying for it. 65 to 67. So as I just mentioned, this is the span of ages where you can start taking your full Social Security benefits based on your date of birth. Anytime before then, and you're going to receive discounted benefits. Anytime after your full retirement age, up until age 70, you're qualified for increased retirement benefits. So there's no additional benefit increase after you reach age 70, even if you continue to delay. That one, and then 72. So 72 is the age that you want to start taking your required minimum distributions from your account. Keep in mind, with Roth IRAs, you don't have to take RMDs, regardless of the age or regardless of your retirement status. And just to be clear, traditional IRAs will require you to start taking RMDs regardless of your employment status. With your current 401k, if you're still employed, that account in particular is not included in the RMD calculation. So, for example, if you might have a traditional IRA, you might have a rollover IRA from previous jobs, but you may still be working. The balance inside of the IRAs will be included inside of the RMD calculation. As long as you're still working in your current job, your active and current 401k is not included into the RMD calculation until you retire, until you stop working there. It's important to remember to take the RMD. If you don't, it's a 50% penalty, so it's pretty hefty. So, someone like myself, an advisor, can help you, remind you of these key dates as well as other big decisions. But to be fair, ultimately, the responsibility for creating a retirement income stream, it's going to be on you. I mean, you're the one who has to call the shots and set the time and put some of these things in motion. I can't apply for Social Security for you. I can't apply for Medicare. Obviously, I can advise you, but you're the one who actually has to fill out the paper, or we can help fill out paperwork, but you're the one who actually has to do these things. As I mentioned, investment doesn't have to stop when you retire. One strategy many use is placing a portion of the investment portfolio in investments that have growth potential. You may have heard how some retirees put all their investments into conservative instruments such as bonds, so they can limit their risk. But you got to remember, retirement isn't a 5-10 year deal. Hopefully, it's a 25-30 year endeavor. And you're going to have 2 or 3 market cycles in there that you need to have some growth in order to maintain pace with inflation, based off what we talked about earlier in the presentation, as far as how the cost of living adjusts over the years. By putting everything more conservatively, it doesn't generally keep pace with inflation, like I mentioned, but also you're not going to need to access all your money the first year you retire. So there's some money you're not going to touch for a long time. And no matter the size of your portfolio, you got to consider putting at least part of it into growth investments, like I mentioned. And that way it keeps pace with, with the inflation, but then also, it's not only inflation because some things follow the rate of inflation. Some things, granted, education is different. If you're retired, usually you don't have to pay for education, but some things have their own inflation rate. A silly example that I used earlier on was a cell phone, and that, when I first started out, 2004, 2005, I can easily ask people 10 years ago, what was your cell phone? You didn't have one. Now, all of a sudden, cell phones have become a part of our lives. These days, it's internet streaming services. These things weren't around. So it's may not necessarily be inflation, but there could be things that come around that become part of our everyday lives that we can't anticipate. So you have to plan for some kind of growth. A good starting place is to understand the tax expectations for each of your retirement accounts. So Roth IRAs and cash value life insurance policies. These are examples of tax-free accounts. These are vehicles that have generally been invested with after-tax money. In most cases, there's no deferral of taxes. So when earnings are realized, the money then grows tax-deferred and can be withdrawn tax-free, provided certain conditions are met. Traditional IRAs, annuities, and your 401k. These are examples of tax-deferred accounts. So you may invest using either pre or post-tax dollars, depending on your circumstances, and the options that are available to you. The contributions generally grow tax-deferred while held in the account, and previously untaxed amounts are taxed at withdrawal. So things to consider with the saving strategy is that funds are generally taxed as ordinary income upon withdrawal. Yeah, as I mentioned, there's before age 59.5, there's a 10% penalty, but after 59.5, anything you take out from these accounts are taxed as ordinary income. So if you take out $100,000 from these accounts, the government thinks you made an extra $100,000 that year. And you got to keep in mind again about that age 72, about the RMD. So you may not have to take some of the money out right away, but at age 72, you have to. Other accounts, non-qualified investment accounts, so CDs, bank accounts, stocks, bonds, mutual funds inside of non-qualified investment accounts. These are what I call taxable accounts. These are funds that have been contributed to with after-tax money, and any dividends, any interest, any gains. It's all taxed, whether at the capital gains rate or it's taxed as ordinary income, depending on the type of income that's being generated. So dividends and long-term capital gains may be taxed at a lower rate than the income. So interest may be taxable even if it's not received, and that's important to remember, because if it's things like a CD, if you're keeping in the CD for a few years, then it's you're going to be taxed annually, even though you technically haven't gotten the money, or even an original issue discount, or even shorter term debt instruments. There's different tax consequences here. So while the other accounts to the left of the slide, so the Roth IRAs and traditional IRAs, have very easy tax issues in that. Roth IRA is tax-free, you don't have to worry about it. Traditional IRAs, you only have to worry about the tax upon withdrawal. Anything you do inside of the account essentially doesn't matter. But when you get into the non-qualified piece, so the accounts on the right, you got to look at each one, because each one has different parameters and different things as far as the different tax consequences. So when we look at tax diversification, so this is what we call our tax control triangle. And to be fair, it kind of goes through some of the things that we've already talked about in that. In this bottom left corner, you have the taxable account. So money goes in after tax. Any interest, any dividends that you've earned gets taxed at ordinary income. And then you have a capital gains tax. So if you buy Disney at $100 a share and you sell it for $125 a share, that $25 difference is taxed at capital gains. Could be short-term, could be long-term, depending on how much you held it. Tax deferred. Money goes in pre-tax. When you take it out, you pay ordinary income tax. And then if it's tax-free, usually money that's gone in after tax, and it comes out tax-free. The point of this is that you want to, just like you want to be diversified in your investment portfolio, you want to have a tax diversification. Because if, for the most part, if everything is here, I'm actually not sure if you can see my mouse. I don't think you can. I was just circling something with my mouse. I really don't think you can see that. But if you're in the bottom right and it's tax deferred, which tends to be where most people have their money, because the 401k has been around longer. The traditional IRA has been around longer than, say, the Roth IRA. You can put more money into those plans. Some people don't qualify for a Roth IRA. So by default, more money is there. But because more money is there, then you're setting yourself up for a huge tax bill in retirement. So for as best as you can, and that's where earlier we had talked about conversions to take advantage of certain opportunities at certain times, you want to try to diversify into different tax buckets, because then you can really try to dictate your income in retirement. So on one of the earlier slides, I mentioned that we're in a relatively lower tax bracket now, at least for the next few years. What you may want to do is pull money from your 401k, IRA, create that taxable income, and save money inside of your Roth IRA, life insurance, and other tax-free areas to help soften the blow of taxable income down the road if the tax brackets do go up. I'm just going through the slide here because I explained everything without having to read it. So there are certain things here, again, because taxes are unavoidable, there are certain things here that we can use to help reduce your taxes. So one, it's going to be giving to charity as a way to lower your taxable income. To deduct charitable donations for federal income tax purposes, you have to itemize your deductions. So the recent changes to the tax law have increased the standard deduction, meaning less people can itemize. But I think for last year, I'm not sure what it is for this year, but taxpayers can take a $300 charitable contribution deduction even if they don't itemize. Recognizing long-term capital gains, if you'll be able to take advantage of the 0% rate. So if you're in a certain income bracket, I believe it's up to 40,000. Don't quote me on that, but if you're in a certain income bracket, then you can have a 0% long-term capital gain. If you're in higher brackets, you can sell stock at a loss to offset current capital gains, and then generally up to $3,000 of your ordinary income. So that you can carry forward some of these unused capital losses. People in a higher tax bracket can also consider investing in municipal bonds to generate federal tax-free income. If you can postpone income to a future year if you think you're going to be in a lower tax bracket. So sometimes with clients, we'll talk about the income that they need, income that they want to take, and saying, all right, based off where income is this year, especially if it's in the year that they retired and they had working income, then we can kind of take a look at, does it make sense to take income in this tax year, or should we be waiting until the next tax year? Selling your home. Assuming rules are met, you can exclude gain from the sale of your principal residence up to $250,000 if you're single, and $500,000 if you're married, filing joint. And then again, converting traditional IRAs to Roth IRAs. So given the changes made by some of the taxes that, or some of the tax bills that we had talked about, you got to work with your tax advisor to determine which strategies may work. So I always tell clients that there are, I don't necessarily give tax advice. There are a lot of different things from a tax perspective that I know, but it only gets me to a certain point. I don't do taxes, or I don't do your tax return, especially as we get closer to April 15th and now in mid-May. Thank God I don't do tax returns. But there's going to come a situation where you may need a tax advisor. And what I always tell clients, that I want to be able to get introduced to your tax advisor, because there may be times I suggest something and I want to bring it up with them because they know a different side of your situation than I do. So I want to say, I'm thinking of doing A, B, and C. Mr. and Mrs. Accountant, what do you think? Because what you don't want is to take my advice and then you go do your taxes, and then the accountant's like, what idiot suggested this? I'd rather suggest something and have the accountant say, no, that's a dumb idea, don't do it. I'd rather have that answer than for you to do something and then have it be a surprise to the accountant later. So whether it's, as an aside, whether it's the accountant or whether it's the estate attorney, advisors or financial advisors tend to be the quarterback of the situation, but they need to be able to work with those different professionals because of all the different things that could be a part of this. So there are some things that you can't control. So it's we talked about taxes, and it's also unexpected events. And so you can help protect yourself from this certainty of uncertainty by buying insurance. Nobody likes insurance, but it's there for a reason. So it's a critical aspect of your financial plan during your working years, and it's still an important consideration as you think about your retirement paycheck, because protecting what you've earned is important. Your life savings isn't something you can easily replenish. So while you're working, you'll want to consider beefing up your health insurance, and you'll still be. And if you're still outside, you want to be, no matter what, you want to beef up your health insurance. If you're still working, adding disability insurance, or if you have it at work, making sure that it's appropriate. So you can be ready for whatever life throws at you. It also helps to have some cash reserves set aside for emergencies. So depending on the situation, we tend to advise about 3 to 6 months worth of cash reserves, depending on the income, depending on the type of income that you have. But as we approach retirement, if depending on the type of insurances that either you have that you qualify for, or quite frankly that you're not willing to hold or don't want, we need to make sure that we have enough cash reserves. So if we don't have certain insurances, then we have to make sure we have enough cash on hand in order to plan for these things, because things can happen. And it's not just bad things, good things happen too. You need to make sure you have that. Protecting the people and causes that are important to you. So if something were to happen to you, this is where life insurance can ensure that your family will be taken care of. And then protecting against risks. So, damages and injuries are rare, but obviously they happen. And so you want to be prepared, not just for accidents that may happen to you, but also for anything that may involve other people. So here it's home insurance, auto insurance, or even an umbrella policy. You want to make sure those things are up to date because while it tends to be more known as far as disability insurance and life insurance, but another thing that could really make a dent in your financial situation if something happens where you're in an accident or something happens on your property, you got to make sure those things are in place as well. So as we wrap up today, I want to encourage everyone to think about the items we discussed, and with which items a financial advisor can be most helpful to you. So the ones on the screen, these are just a few things to consider discussing your retirement paycheck with your advisor. As we set aside time for Q&A, I'm going to leave the next slide up for a bit so everyone can have my number and email. Please feel free to ask questions now. And if anybody out there has any additional questions, please don't hesitate to reach out. I'm more than happy to answer anything that you may have, especially if it's more particular questions about your situation. And if anybody wants to set up a time to get together to review on a more in-depth basis, that's perfectly fine as well. So thank you.
Dan, thank you so much. I mean, that was a lot of very helpful information, and we certainly appreciate you kind of walking us through that. And we did get a number of questions, and if it's okay, I'll start throwing them at you, knowing we want to be conscious of everyone's time. One question that was pretty common,
Yep.
both in the pre-submitted and also during today's presentation was, as people move from job to job, is it recommended that they should roll over their accounts when they shift? Like here's an example. If someone has a 403B and a
Yep.
past job, does it make sense to roll that over into their current portfolio or to keep it separate? A few people have that on their minds.
Well, as you can imagine, it depends. And I'll go over the different reasons why you would or would. So some pros around doing that is that inside of a 401k or a 403b or any type of retirement plan for work, the options are limited. So they're institutional accounts. When you go to your job and you're signing up for the 401k, they're not going to give you a Cheesecake Factory set of investment options. You would just get lost. So they're going to give you 10 to 15. Sometimes it's more, sometimes it's less. If you move that into an IRA, which is a retail account, your own account, your options are whatever it is that you want. So if you're working with an advisor or if you have a regimented investment strategy, that can be beneficial because it allows you to take advantage of different asset classes during a good market. And also it gives you more places to hide during a bad market. Having said that, retail accounts are going to be more expensive. There's no way to sugarcoat that. Inside of a 401k, they're not free. There's still internal expenses inside of it. But by default, they're probably going to be lower than what you would pay inside of an IRA. So you have to look at what that different costs, what the different costs are, what the different fees are, and say, are you going to be able to take advantage of the different investment options by rolling it over? Because if you're going to be using the same fund with the same fund of funds or the same life cycle fund, it's going to be cheaper to do inside of the 401k. There are sometimes with bankruptcy rules that they can go after an IRA that won't go after a 401k. Another reason to look into it is if you have company stock. So we tend to find people who are working for companies for 30 years less than we did, say, 20 years ago or 25 years ago. But it's important to recognize if you have company stock inside of your 401k, that's going to be treated differently than other assets inside of the 401k. And so while pulling money out may be ordinary income, if you did it a certain way, you may be able to get long-term capital gains rate on that. I mean, there's another that's called net unrealized appreciation. It's called NUA. There's a whole other presentation just on that alone. So for as best as I can answer, there are different things to whether it's a pro or a con. More often than not, it comes down to what the costs are. It depends on what the investments are going to be. But if you have a handful of them, probably some consolidation, whether it's to an IRA or even your current employer plan, is going to make sense.
Can you talk a little bit more about some of the options for beefing up health insurance? A few people asked that when you touched on it near one of those last slides. Like, what are some of the options if someone is thinking about beefing up, an asset like that?
Admittedly, I know less about that. Because a lot of people take advantage of Medicare. I'm trying to think. I know of one client that purchases their own outright insurance, and it's for what they pay, it's expensive. I mean, there are different plans out there, but it's usually Medicare is the base. Unfortunately, I'm not as familiar.
Yeah. But it was good that you kind of highlighted that as an option. Here's one and this was pretty common from on folks' mind is, in addition to kind of family and lifestyle reasons, can you talk a little bit about the pros and cons of retiring early, say 65 or even a little bit before 65? If you have a client come to you and say, I'm thinking of retiring on the earlier side,
Yeah.
how would you advise that person?
Well, you got to look at the money, and you got to say what's your next step. Because for argument's sake, if they're 55 or 60, and we always assume worst case scenario that you're earning nothing. So even though we talked about having retirement income, we have to assume that that income isn't going to be there. So if that's the case, if you can retire at age 60, the benefits are that, yeah, you have more time to do things. Financially, I would say, it may give you the potential to explore a different career that you wouldn't have anyways, because if at age 65 you retire and now you're trying to you need to get a part-time job or you want to get a part-time job, there may be people less willing to hire you because you're older. It just is what it is. If you're retiring at 55 to 60, and let's just say you have enough assets to get you to a certain point, but you just need a little bit, then you could potentially start out somewhere at 55 to 60 and almost build a second career in order to get you additional benefits through that. And by the time you get to 65, when you would have needed an extra $1,000 a month, you've built up enough that your income is now more. I mean, it is more of a, I think I'm more inclined on the health side and the family side to say, if you have enough money to do what you need to do, spend it, because you never know what's going to happen health-wise. And if your health isn't there, then there's no point in any of this. Because I've seen a couple of cases where people were retiring and a couple of years later, they either get cancer, they get sick, or they're not as active. It's like, you spent your whole life earning this money. So if you're retiring early, not only do you get to enjoy that aspect, but if it allows you to build a foundation in other employment that could help bridge that gap, then it may mean that you could retire sooner.
For people who left the workforce for a while, whether
Yeah.
to raise children or whatnot, and then re-entered, what strategies would you give to those folks who have kind of re-entered the workforce a little bit older to try to build up a portfolio with an eye toward retirement?
Well, it's definitely, depending on when they start, it's definitely looking at those catch-up contributions that we talked about. So they give you the ability to put more money in, and assuming that you're in a spot where your expenses may be a little bit more controlled or even lower, in that if the kids are out of the house, or if you know what tuition is going to be, or if the mortgage is paid off, or again, it's controlled, so you have an idea of what those expenses are. There's a potential there for you to put away more money. And I think it's important to also look at Social Security if you've been away for that long. So you don't get the Social Security statements mailed to you anymore. You have to create an account and get it. And so it's always important to take a look at those to see where you are with respects to qualifying for Social Security, because you need 40 credits, and to make sure that the years that are being recorded are accurate. So if there's a gap in working years, you want to make sure that the years you had been working are accurate. You don't want to find out at age 64 or 66 that, geez, there's a disconnect somewhere. You want to find that out now, and as you do start to go back into the workforce, make sure that that's being part of the calculation.
And then if you're willing, we'd like to close on a fun one.
Okay.
At the beginning, a couple people asked this: is you started with the case about the baseball cards and kind of some other non-traditional forms of revenue. Can you talk a little bit more about like someone asked, like, what should we be looking for if you're talking about baseball cards or things like that? Like what should we be looking for? How can we find some hidden cash?
Well, I have the story I have is I have a client who has a wine collection, and so this is 2006, I first met with him, and in my mind, I'm like, geez, if I had to guess, maybe maybe the wine's worth 250,000, maybe he had 750,000 in assets. This is just without knowing anything. This is just a guess going. So we go through his assets, and he has about 250, 300,000. He's like, Dan, then there's the wine. I'm like, well, how much is the wine worth? He's like, it's worth well over $1 million. And he takes me downstairs to his cellar, and it's not big, but it's just filled to the brim with the stuff you find at steakhouses, like the cult stuff. And he pulls out a bottle. He's like, Dan, I left the $28 price tag on this because it's now worth a couple $100. He has his name on distribution list that he's like, I can sell my name on the list because there's a waiting list for some of these. He told me somebody paid him 15 grand cash for a bottle of Opus One. It was like one of the bigger bottles. Now, granted, that's something that started out in the 80s when Napa Valley wine wasn't as popular or in demand as it is now, and that's something he's just, it's not my fault the stuff went up. So with that story, I kind of say if it's something that you like, if it's something that you're passionate about, chances are there's going to be other people who are just as passionate. There's no issues with collecting it. Make sure that it's organized. Make sure that you know where you got the stuff as far as keep track of it. Because at one point, whether it's now with baseball cards or even with something like wine, it's going to be important to show, hey, I paid this much from this source, the winery or this store, so you can kind of keep track of that. I don't know if that answers the question, but if you're passionate about something, feel free to collect it, and it may be lucrative, but it can't be, it shouldn't be your only thing.
Yeah, no, of course, but no, your example of wine is a good one. So if you're a wine connoisseur, or if you're into baseball cards, you don't want to offload that just yet. You want to.
Those meetings are fun.
I bet. Well, Dan, many thanks for sharing your time and knowledge with us today. This was wonderful, and we are so grateful to you, and we hope to continue offering more of these Holy Cross webinars throughout the coming months. So stay tuned for upcoming notices about future dates and topics, including a webinar on Wednesday, April 21st, about the Boston home buying market. So more details will be shared on that soon. But in the meantime, Dan, thank you, and everyone else on the line, have a great evening. Thanks for joining us.